First it was SBF and FTX. Now it's SVB and Signature Bank, SBNY, with more potentially coming. So why is this all happening? Well, let's take a look at our banking system and see how that works. So banks take your deposits, they pay you a small amount of interest, and then they either lend out the rest of the money or invest it. For an example, let's use a $100,000 deposit. The bank will hold a certain percentage of that, and then they try to make the money with the rest. So in this case, let's use 10%, $10,000. They'll pay you a small savings account interest rate of like a 0.5% on your 100,000, which is $500 a year in interest. But if they can make 2% on the 90,000, they make $1,800, netting them $1,300 on your money. You multiply that by a ton of people, you get a ton of money. Or they can invest it in a longer term asset and make money there. But in 2008, the Dodd-Frank rule has a HTM, or held to maturity assumption, on agencies where banks are not forced to mark to market, so they don't suffer the market losses, and they don't have to show negative equity on their balance sheet, keeping them tier 1 capital. For example, as interest rates come higher, and those bonds or treasuries that they have a much lower interest rate on don't negatively impact their balance sheet. So a lot of banks like SVB bought mortgage-backed securities when rates were at 3%, and they got a 2% coupon. But the problem is the Feds raised rates so quickly because they quantitatively eased too long and called inflation transitory. So now people are pulling their money out of the banks and putting them into like a short-term treasury at 5%. So it causes a liquidity issue within banks, because remember, banks they only have a fraction of the total deposits available, where they're investing in the rest, and that could be in loans or treasury yields, mortgage-backed securities, and so forth, and they could be not making them much money, where the depositors have multiple options now that interest rates are so high. So SVB was not set up for success to begin with, though. This is very interesting to me. They had no risk management officer for 8 months last year. The CEO is a board member of the San Francisco Fed and sold stock while aware of the balance sheet issues. The best part, though, is the chief administrative officer was the CFO of Lehman Brothers. His name is Joseph Gentile. So their balance sheet, because of that Dodd-Frank HTM rule, showed $12 billion in assets. Well, if they have to liquidate those mortgage-backed securities or treasuries, they actually have a $15 billion loss. So they're negative $3 billion. Well, Kramer decided to shed light on this company and say, or this bank, and say Wall Street is mistakenly concerned. So a big spotlight gets put on them. People dig into it even more, and they realize that they are underwater. So they're forced to sell $21 billion in assets for a $2 billion loss. This causes short sellers to jump in and causes people to do a run on the bank, meaning taking all their money out. Well, now they can't meet demands, and FDIC only covers $250,000, where 93% of their money in that bank was outside of FDIC insurance. So then you have Janet Yellen saying they'll be fine, it's resilient. Then she said, no way, no shot of a bailout. Well, they didn't think about the payroll portion of it, where all the business owners that bank with those, all their employees. So they stepped in and basically bailed them out, the Bank Term Funding Program. So it's basically going to buy those long-term treasuries or whatever they are at the maturity value, even though they're not, worth that right now because of a high interest rate environment. So what does this all mean? I think you've seen rates drop significantly, so we'll probably see a little easing off of any rate hikes in the future. Hopefully, maybe even tapering back. Tomorrow we have CPI data. We should see that in that shelter cost, that lag in shelter cost that makes up 43% of core CPI data. Hopefully we'll see that drop significantly. So I'm hoping that this week is the week we've all been waiting for, where we get some relief on interest rates. So I will keep you posted with the CPI, and I hope everyone has an amazing week. Thank you.